Welcome to the Big Money Question Show. I'm Rachel Rickard-Strauss, Personal Finance Editor at This Is Money. This week, diversifying and, wait for it, I love it, diversifying. What is it and why? What is diversifying and why is it important? David Coombs is here. He's going to tell us. He is Head of Multi-Asset Investments at Rathbones. Thank you so much, David, for joining us.
No problem.
So, David, we'll start with the big question. What is diversifying when we talk about it in terms of finance?
So basically what we're trying to do when we diversify a portfolio or investment strategy is try to insulate a client's investment portfolio from some of the worst falls during periods of market distress. But diversification comes in many forms, and the key is to ensure you have assets that are moving in different directions with each other. That's what true diversification is.
Okay, so it's not just a matter of a little bit of everything, it's making sure that you have things that work together. So when one thing goes up, the other thing might fall, but then it might conversely happen the other way as well.
Yes, so you mentioned diversification, and that's when you just have a portfolio of lots of investments, but they all move in the same direction. So you just lose money more slowly maybe if markets are falling. What diversification really means is having some insurance in the portfolio. And if you think about your own household account, you make an investment every year that you hope to lose money on, and that's called fire insurance on your house. So you pay a premium, you don't really like paying it, but you do it because you'll only make money on that insurance premium if your house burns down, and you're pretty glad you got it, right? It's the same with an investment portfolio. Quite often, you need to think about investing in some investments that you hope you'll lose money on. I know it sounds strange and it's a bit sort of counterintuitive, but that's what you need to do. If you've got a portfolio where everything's going up, it feels great, absolutely, but it probably means you haven't got the insurance. If the house burns down, you've got a bit of a problem of finding somewhere to live.
That's so interesting. So if you have, two people with portfolios and they're comparing who's doing better, if someone is miles ahead of someone else, they would imagine that they have the better portfolio, or they've got a better, financial advisor, or they're doing something very smart. But you're saying the other person, actually over the long term, might be doing better.
Yes, I mean, typically, if you're investing over the long term, it's about compounding returns. It's not about being heroic, okay? And yes, it's very exciting when your portfolio is up more than everybody else's, but you've got to ask the question, what risk am I taking to achieve that? And it might be fine, but you should question it, because at the end of the day, stock markets only produce sort of inflation plus 3 to 4% per annum on a general basis. If you're continuously doing more than that, it could be you're taking more risk than you think. So to use a really old cliche of the tortoise and the hare, in investment terms, you're much better off being the hare. Because, as I go back to my earlier point, it's great when everything's going up in your portfolio, you feel good about yourself, and I've seen many times when you have, 80 stocks in the portfolio going up and 5 going down, you really hate the 5 going down or whatever, but actually there's a reason why they're there, and it's sometimes just discipline, making sure that you remember that.
You talked about it in terms of home insurance, so could you give us some ideas of the home insurance of the investment world? What are the things that you want to have there that might not be doing so well, but they're sort of protection against everything going wrong?
Well, it's a bit like, again, your house. You insure your house against fire, flood, you insure your car. You have lots of different types of insurances for different risks, okay, medical, legal, etc., etc. And unfortunately, in the investment world, it's no different. You can't just buy one type of insurance. So, for example, typically, you would buy government bonds. And at the moment, the yields are not very high. In fact, they're lower than inflation. You would expect to lose money on them if you bought them today for the next 5 years. But they're still worth buying because they do insure you against certain market risks. But if interest rates in the UK rise very quickly over the next 12 months, you could find those bonds fall at the same time as equities, so they won't provide insurance for that eventuality. So you might want to own gold or some commodities in your portfolio that might go up with inflation, or some inflation-linked investments. So you have to have different types of investments for different risks, and that's what makes it, one, an interesting job to do, but secondly, make sure you've got lots of different types of insurance, different currencies, commodities, property, but ensure that all the risks that you can think of, you've got covered. Now, unfortunately, that's impossible, but that's the way to think about it. I've got lots of different types of insurance, not just one.
Okay. So it's not, as I was saying earlier, that you have one thing that sort of you could pair with another. It's much more kind of interwoven than that. Some things will mitigate against one risk and not another.
That's exactly right. As I said, I can foresee. In fact, we saw it in the last couple of weeks, where bond markets and equity markets fell at the same time. It's sort of portfolio manager's worst nightmare. And if you think we're going into Brexit with a lot of uncertainty in the UK right now, I would say you want a more internationally diversified portfolio to offset Brexit risk. Now, if you look at the textbooks, Brexit risk, of course, doesn't exist because it's never happened before. So trying to identify the insurance for Brexit risk is very different to looking for insurance for, say, a stock market meltdown in Japan. So for Brexit risk, the portfolio insurance might be having quite a lot of money in US equities, which are based in US dollars, because they should do well whatever happens to the UK economy.
It's starting to sound a bit complicated, having such a broad portfolio like that. Have you any tips for someone who is investing themselves on how to make sure they have a broad enough spectrum and they've taken these factors into consideration? Yes,
I think there's some easy checks. First of all, if you're looking at your quarterly valuation of your portfolio and everything's going up at the same time, be afraid, because it probably means you've not got the diversification you need. Very simply, if you're looking at one economy like the UK, make sure you haven't got too much exposure to one sector, be it technology or retail or banks. So you want a good spread across different parts of the economy. Ideally, you want geographic spread, so check you've got exposure to not too much to the UK economy, particularly at the moment because of the Brexit situation, as I've said. Check if you've got exposure to commodities, property, and some other asset classes and different currencies. Don't overthink it, don't overcomplicate it, but just make sure you've got a good spread. And the basic test is, last week's a good example. Look at your portfolio last week. If some of your investments went up last week, you've probably got a good diversified portfolio. If they all went down, probably not so good. I mean, it's obvious to say. And that's the key, is making sure you've got a good spread across both geographic and different parts of the economy.
And you can get funds that do this for you. You don't have to sort of, as an individual, go out and hand pick all these different elements.
No,
Is that the way to go?
No, I'm kind of talking my own shop here, but yes, there are multi-asset funds such as I run and other groups do. The key, again, when looking at multi-asset funds or balanced portfolio funds, which have more than one asset class, is, again, you probably don't want the funds that go up the most when markets are strong. You want to look at the funds that have been more protected the capital when markets have been a bit more volatile or indeed they've been falling. So look at how they perform during bad periods in the markets. That'll give a better indication of how diversified they are. It's a rough test, really. Those that held up better last week, for example, are probably more diversified than those that fell further. But those that fell further probably made more money last year. But it's a very sort of quick and easy way of seeing what sort of risk that they're running. It's not, you then have to do a bit more work, but it's a good sort of first stab at it.
When we talk about diversifying, there are loads of different types of asset that come up. As gold, for example, is seen as this kind of a safe haven when things go badly. But then there are other types. I think we talked earlier about Amazon.
Yes.
Which I don't think people would think about in that context.
So when I meet CEOs of many companies these days, a lot of them will have a strategy to combat Amazon, because Amazon is increasingly entering into different markets, making acquisitions, testing different markets, different parts of the economy, whether it's in data, in cloud computing, in retail and distribution. So Amazon is so strong and so powerful and has such deep pockets and so much capital to invest. So immediately Amazon says it's going to invest in, for example, food retail. All the food retailers' stocks fall in price. If Amazon says, oh, we might get involved in, I don't know, selling credit cards, for example. They haven't, but say they did, you probably find credit card company share prices would fall. It's the Amazon effect. It's become a really big risk to portfolios. So you might consider holding Amazon to offset that risk. Even if the Amazon share price looks expensive and you think, oh, it's a bit risky, think about it from a portfolio diversification point of view rather than just looking at Amazon in its own, for its own self. It could help you diversify. Say you held Next, for example, Amazon might diversify the risk from Next. It's a very simple example. So, and Google would be another example of that, of holding a stock that is starting to get into advertising and other parts of data capture. These big companies are starting to have an impact on domestic companies. So having them in your portfolio helps you offset some of that risk. So diversification comes in many different forms.
I wanted to ask you, finally, what you think of sort of rules of thumb around diversifying. So, I mean, often you'll hear numbers thrown about the minimum number of stocks that you should hold to make sure that they are suitably diversified, or the minimum number of funds, or even sometimes you'll get funds that claim to be all singing or dancing, you only need the one. Are there any kind of rules like that that you think are worth something?
I mean, people have spent many years analysing this and come up with number of what the minimum number of shares you need to represent the market risk, and a lot of the ETF world does this. They're called sampling, because they often don't buy every stock in the index, they'll just buy a certain percentage. I don't know if the number is 20, 30, 40, there's lots of very smart people that tell me that, and certainly when I was training, the textbook said a good portfolio of 20 stocks was diversified enough in the UK. Most of the textbooks around when I was training have been shown to be totally flawed, and so I think a number is kind of irrelevant, to be honest. I think it's really having a good spread of different asset classes, of, if you're investing in equities, having a good spread of geographies, but also having a good spread of sectors, as I said. Make sure you don't have any over biases. And if you think back to the last really major, the last but one actually, is the dot-com bubble is a great example where people's portfolios were really dominated by media and technology companies because they were sexy and exciting, and that's where the money was being made, and they dominated the market. Last year it was the FANGs, Facebook, Amazon, Netflix, etc. Make sure you take profits early, and make sure you still buy the stocks that have gone down in your portfolio, and keep reinvesting those profits, and don't just run the winners forever. I mean, I think that's the rule of thumb. So it's not the number of stocks, it's making sure you have exposure to all sorts of different parts, because investment is often run also by fashion, and sectors get really in fashion and out of fashion, and then they suddenly change overnight, and you don't want to get the wrong side of that trade.
Yeah. Requires a lot of discipline, the way you describe it, to when things are doing well, there are those are the things that you might want to feel like you want to hold on to or buy more of. But you're saying once you have a diversified portfolio, make sure that it doesn't sort of get warped.
Make sure you rebalance. You have to rebalance it all the time to make sure your risks are always constant. Investment is all about discipline. It's not about being heroic. It's not about making massive predictions. It's doing sensible things, using common sense, and also about discipline. So last Friday, for example, when the markets were falling, we spent all day discussing them but did nothing. And actually doing nothing was the right thing to do. And it is sometimes. It is about discipline. Just because the market's falling, everything's ready, think, oh, it's all cheaper, let's buy. Sometimes it's not the right thing to do. So investing is 95% about discipline, in my opinion.
Okay, good message to end on. Thank you so much, David, for joining us and introducing me to the word diversify.
You're welcome.
And thank you so much for joining us for the big money questions.